Hey guys, what is up? This is Gen Z Finance and I'm back with another video for you guys. This one is going to be about how I doubled my money in the course of around 2 weeks with one stock and whether or not I'd recommend trying it on the Robinhood app. So if you guys are new to investing and don't have the Robinhood app quite yet, I'll put my link down in the description below. If you click it, you can sign up. All you need is a valid social security number. You need to be 18 years or older. And you also have to be a valid U.S. citizen. And when you sign up with my link, you can get a share valued up to $200 for free, and you can move on from there. So if you want to, go check that out, and let's move on to the rest of the video. As always, guys, I am not a financial advisor. These are simply just suggestions and ideas that I've come up with for my own investments. If you choose to follow what I do, it is at your own risk, so be careful and do your own research before you perform any of these trades. Alright, so now with the video, the stock that I used to double my money in just around 2 weeks did involve Tesla. Now for the longest time I have been watching Tesla, and a lot of people said it was going to be overinflated. Here, we'll go down to it and we'll take a look real quick right here. It was around in January when I started looking at it. Everyone was saying it was overinflated. I watched it go all the way up. Right now it says 183, but it was at around $900. And at the time it went up like 500% or something like that up to February. And then it went down due to the pandemic all the way down to around $350. I really contemplated buying it, but again, I just thought I'd just wait and watch it and see what happens. And it kept on climbing. It kept on climbing, kept on climbing. Right around here, it was at $1,000. Then in July, it took off. It was up to over $1,600. But throughout all of July, it ended up plateauing into August. Now, I wasn't going to invest into Tesla except for when I heard that around August 6th, that they were going to implement a 5-to-1 stock split. And for those of you guys that don't know what this is, it's meant for stocks that are valued at a really high amount that everyday people don't really want to put that much money into. So like for this one, it was at $1,500. Not a lot of people like buying stocks that are that high, and they might see it as more of a risk. So what Tesla did is they did a 5-to-1 split to lower it down to 300, which it shows right now it's at 300. And that is when I figured, all right, Tesla is going to move either down or up within the next couple weeks. So I bought what is called a spread. I bought a put debit spread and I bought a call debit spread. And these, you can't really do it on Tesla right now because they're still changing the 5-to-1 stock split. So we'll go down and we'll pick Amazon. Amazon's very high value, just like Tesla was. And what I would do is I'd go up around 5 or 6%. I'd go all the way up, and I would buy a call, and then I would sell a call that when the strike price was $10 difference, so it's $1,000 that you could your max profit would be. Now this was around $305, but then I would also buy a put spread, and I'd go down a ways. I'd buy, say, like this one, and then I'd sell the one right below it. Now these are called debit spreads. To buy both of them, it was around $500, and the max profit is around $1,000. So you can make like $465 off of this. It's only meant for volatile stocks, and considering I didn't know if it was going to go up or down, I bought both. Usually people just buy a put spread or a call spread, and but this way, if it went up a lot or if it went down a lot, I would make the $1,000. All right, now for the actual numbers of what I did is I ended up buying a 1980 buy, and I bought a 1990 sell call debit spread. So it was a $10 strike price, so it was $1,000 I could earn, and this cost me $230. And then I also bought a put debit spread at 1800 sell and 1810 buy. There's another $1,000 strike price, so I could make up to $1,000 if it went past either the 1800 or if it went past the 1990. And in my case, I ended up spending $250 and $230 on this, so it's around $480. So my potential profit was $520. Now you fast forward to Friday, and it actually went over $2,000. So I made that $1,000. I got my $480 back, and then the $520 profit. Now, for any of you guys that are new to debit spreads, it actually it buys the 100 shares and it sells it when it can. So this is all the processing of where my buying power is actually negative 200,000. This can look a little scary, but after a couple hours, they will update it, and this is the updated price that they put into it. So I ended up making $995.59 off of this put and call spreads that I did that week. Now fast forward to the next Monday, I figured it would still be volatile the next week, so I ended up putting $475 in. I bought these together, so it was just one price that I had to look at, and I bought a 1920 put and I sold a 1910 put. So if it went below 1910, I'd get the $1,000 from the strike price, and for this call debit spread, I bought a 2185 sell and a 2175 buy. So if it went above 2185, I would also get the $1,000 from the strike price. Now fast forward, it ended up being around 2230 or 2215 at the end of Friday, and I ended up making the $1,000, and so I ended up making the $525 in profit, and I got my $475 back. Now these can be pretty risky, so if you decide to do one of these, make sure you pick a volatile stock like Tesla that makes big dips and climbs quite a bit in a given day. And again, this is what happened since it was a call debit spread and a put debit spread. I ended up buying the 100 shares. Well, in this case, it was around 200 shares because you buy the put one and the call. So it was around $200,000 that I was negative in my buying power. But then after a couple hours, it goes right away, and they put this into your account, and I made $995 and something cents on that one as well. I started with $875 before those 2 weeks, and mainly because of those two trades, I brought my total up to around $2,000. Now, that's not a bad return. However, it was a decently risky investment, because if it stays stagnant at around the same exact price, see, like right here, if it would plateau, then you end up losing your call spread and your put spread. So then you lose the total investment of around $500 that I put in. That's just gone. So do with it at your own risk. But now for the question of, will I do this again after the stock split? And I think I might. The stock's down to 443 now because of the 5-to-1 stock split. And generally, if history repeats itself, most stocks that undergo a stock split have a very good return throughout the next year. And so I would hope this one would go up and it would stay as volatile as it was the past couple of weeks. But then another factor that would get me to do it is if the spreads are cheaper. So the strike prices of the other ones were $5. They were in $5 increments. And that's a $500 each strike price you move up. And that's quite a bit of money for some people. And if it were to go down to like $1 difference in each strike price, I think I would I'd do these more often, because the risk is a lot lower. It might have the same percent that you can make on it. So like how I doubled my money each time, it still have that, but it would be like a $50 investment instead of $500, like what I did. So it's going to mainly depend on if it stays volatile and if the strike prices differ or smaller. Again, I am not a financial advisor, and everything that I say are just suggestions and ideas for my own investments. If you choose to follow the moves that I make sure to do your own research on it before performing any trades, and remember to do it at your own risk. That is it for this video. I hope you guys enjoyed and learned something throughout this video. I'd love it if you guys hit the like button and subscribe to my channel. It would mean a lot, and I'll see you guys in the next one.